Once upon a time, everything in currencies was measured against the dollar, and in a large part it still is. But in Asia, attention is increasingly being paid to the rate between the renminbi and the yen. So pity policymakers in the rest of the region, since both of these regional giants are on the slide. Now, dollar rates still matter. Last week, the offshore renminbi hit 6.7045 against the dollar, its weakest level in more than 5 years. The yen, meanwhile, fell back to 107 to the dollar, a whopping 5.3% slide from its early July levels. The levels of both are critical for the rest of the region, as they make up between 25 and 45% of Asian currencies' trade-weighted baskets. Looked at over a longer time frame, Japan and China want for a sliding currency. They've got some justification for wanting this, since they've appreciated the most in nominal and real terms. The chart shows nominal changes in each currency's trade-weighted value on the horizontal axis and the real effective exchange rate adjusted for inflation, that is, on the vertical. What you have in the middle is a collection of export-dependent currencies who are struggling to improve their terms of trade even when their major trading partners are strong. Emerging Asia's policymakers can hope that inflows will slow, with some room to believe they can, and they also have room to ease monetary policy in most cases too. But investors, as well as those policymakers, should also keep an eye on the exchange rate between the renminbi and the yen. The yen is a big part of the currency basket by which China measures the renminbi, and Nomura analysts reckon that more than half the change in that basket's value over the past fortnight can be explained by moves between those two. The dollar is the dollar, and its headline value won't change anytime soon. But given China's growing might, it will also pay to watch the interplay in Asia between its two dominant currencies.